manage your account. Today's lesson is a trading plan, and then some flow charts showing adjusting those common open trades that you may have. Okay. So first of all, I need to remind everybody, all rights are reserved and copyrighted to ShadowTrader. That means the content in this presentation is presented for educational purposes only and in no way should be considered investment advice. Therefore, the information provided here should not be considered as a recommendation to buy or sell the security. No way considered as investment advice. That also entails that trading options involves risk and may not be suitable for all investors. You should understand all rights and obligations of your options instruments, such as exercise or assignment characteristics that come about with your options you're using. All right, topics in today's lesson. We're going to talk about goal setting. I'm going to show you how to set up a goal to a business plan. We're going to talk about the process, what you need to do, some personal review, how you can set some goals, your expectations, commitments that you need to make, and some trading rules that should be inside of your goal that you set up. Also, there's going to be a couple of additional pieces of documentation that I'll provide in the PDF and also on the replay and on this week's email out to you that will give you a template for setting up a business plan, some goal setting, and you can also then print out the PDF with these adjustments to trades. Second part of this presentation, we're going to talk about adjusting the trade, about trade selection and sizing, and then the last piece, we're going to go through some flow charts. I'm here if the market goes in this direction. Here are some alternatives that I can use. If it goes in the other direction, here's some alternatives that I can use for my trades. All right, let's talk about goal setting, setting up a plan. First of all, you need to do a personal review. What's your personality? Are you conservative, moderate, or aggressive? What is your time horizon? Are you in your 30s, 40s, 50s, 70s, even 80s? All right. You've got different time horizons based upon your ability to either add to or manage this portfolio that you're going to be trading. What are some of the needs that you've got for your family? You've got family obligations, food, shelter, healthcare. Are you older? Do you have to buy healthcare? Do you have to come up with prescription medications? What are your outflows versus your inflows? Are you still earning a paycheck and have inflows? Or are you now on your retirement benefits, Social Security? These should be written down and evaluated so that you get a net number. All right, number one for goals. Set out, first of all, where do you want to be in 5 years? It doesn't have to be exact. Let's say that you've got 100,000 and in 5 years you want that still to be 100,000. There is your 5-year goal. That means you're going to spend what you make. All right, again, what are the inflows? Employment, 401k, IRA, savings, pension, profit sharing, annuities. Those are your inflows. What are your outflows? Net them out from your inflows. Vacations, definitely you need to put in there. All right, now, asset valuation of this goal. Do you already have assets that you have in your portfolio? Stocks, bonds, a house, a boat, whatever assets you have. Now, subtract from those assets the liabilities that are associated with those assets that you've listed. Now you've got a net number that you can work with for this goal setting. All right, take that 5-year goal and pare it down to next year. This is a great time to start doing goal setting for 2020. What are your expected return on your trades? 10%, maybe 15, 20. I give you guidelines. Now, when you're expecting those returns, also think about what type of environment we're in. Can I make 10% on my money and be happy? You can't make it in a bank account. You can't make it with CDs. Annuities are another tough one. So some things to think about how you can get to that expected return that seems to be reasonable. You got to think about the sectors of the economy that you're going to invest in. Technology versus consumer staples or energy or financials. Are we in a rotational type of sector basis? What is in momentum at the time that you're trading? Which ones are trending now? That's some other things that you can use for your guidelines for your expectation. Now, on your trading watch list, I've given you mine. Set up one that is a viable trading watch list, companies that you want to watch and trade. Don't have the whole universe, the 50,000 stocks and options and ETFs that are out there. 20 to 30 is absolutely the limit. So let's say that you are willing to do some due diligence and look into about 20 companies. Put them on a watch list. See how they move on a day-to-day basis. Find out when their earnings are, when their dividends are, what moves that stock, what other companies move that stock. So make that watch list viable to your trading. Issues that you may want to include in this goal setting that raise or lower those expectations. Are we at the top of a market? Are we at the bottom? As I said before, I'm nervous at the levels that we're at. So changes in the market. This should be evaluated at least quarterly. The sentiment to this market. Is it conducive to be buying, or is it maybe a little bit suspect? That's called sentiment. You can Google that and find out if we're oversold or overbought. Right now, the market is very close to being overbought. So that's a negative sentiment. What's the inflation outlook for now and in the future? Number 4, a big issue now, China tariff issues. And I should say, just world tariff issues. Then you can also look at commodities. What are gold and oil doing? Are they getting more expensive? Are they in excess like oil is right now? Is it going up, down, or sideways? How does that impact those issues on your watch list? All right, here is your road to the plan. How do I get this goal? All right. First of all, target returns and reinvestment. Write it down. Write down a milestone. First month, second month, third month. Where did I get to the first month of my trading? Did I make, let's say you're at 12%. This is 20, but let's say 12%. That's 1% per month. So your milestone is going to be a monthly milestone. Did I make 1% on my trading for the month of January, let's say? If I didn't, then why didn't I? If I did, why did I? Use the positives to go forward with. use the negatives to say, did I make a mistake, and can I identify it so I don't make it again? So if you beat your milestone, now you can say, okay, I've beaten my milestone for 2 months in a row. Maybe I want to move that level, that milestone level up, and use your milestone now of the old 1% per month as the floor and the new milestone of 1.5% per month. The other part of this is to limit your trade losses. My guidelines is I limit my losses to less than 15% of the investment. So if I invest, let's say $1,000, I'm going to risk $150. That's the most I'll lose on that $1,000 investment. Second bullet point there says goes to SE. That means secondary exits, adjustments to your trades. As you get more adept in trading, either stocks, options, or bonds, you're going to look for secondary exits, such as, can I mitigate this by offsetting it with some insurance? Or can I sell somebody the right to take my stock if it moves up a lot more and get my 1%, 2%, 5% trade and just have cash instead of holding on to the stock? Next level down, design your trades with higher probability. You can use an analyzer like we use or I use and show you on Thinkorswim. Many other platforms have it also. But I would suggest that if your platform that you use does not have an analyzer to give you a calculated or a math type of probability of success and your risk associated with that you find another platform. Third major bullet point, define the time that you're going to be in this trade. All of the trades that I do as our beginning options have a defined expiration. It's either to that date or before. Don't continually do these trades and add more time to your options or add more time to how long you're going to hold it. Make a definitive holding period for your trading. Here's some guidelines. Credit trades, less than 2 months. Actually, credit trades less than 30 days in this environment make more sense. Your debit trades, like the verticals that we've done, try to strive for 45 days from now till the expiration so that the trend can continue to build. Limit the amount of open trades that you have. It says a maximum of 10. If you're new to this, make it a maximum of 3. As you have more than 3 open trades, your mind starts to say, I don't know what to do. And you get confused and you make bad decisions or bad choices on whether you should stay in or get out. Now, the last bullet point here says exit follow through. That means exit follow through reserve capital. For example, if you are doing bull puts and your objective, that's a put vertical, a short put vertical, and your objective is to take ownership of the shares, you should have at least 20% of the equity cost in cash before you start that trade. At least. All right. A financial commitment. I would say you put down your starting capital, what you can trade with. 25,000. This may be more than some people have, but there's a guideline. What are your capital expenses to be able to trade? You've got to have a computer. If you don't, there's going to be a cost there. Software. The platforms are now free, but you may want to have additional software. Do you have subscriptions that you need to pay for, such as internet access, cell phone access? If you're staying with this advisory service or you want to have some paid information off of the web, that may also be at subscription side. And something miscellaneous, such as your supplies. So write down your financial commitments. All right, on your goals and objectives, again, just a reiteration. Expectation of a % return on your capital invested. Focus on the % return than on the dollars. If you keep positive % returns, the dollars will take care of themselves. Limit an individual option trade to less than 8% of your total portfolio value. That's so you can come back and trade again. You should review all your open trades at least once a week to say, okay, am I still on track? Do I need to maybe exit this or adjust it? When you close a trade, go back and review all those trades that you've opened and closed at the end of the month. What did you do right? What did you do wrong? Write them down on paper. Rank the type of trade that you've done that got you the best performance down to the one that got you the worst performance. Go with the best ones, right? List your strengths and weaknesses in each trade. Were you rushed? Were you agitated when you did the trade? Were things kind of unsettled when you did your trade? Again, hone your strengths and try to mitigate your weaknesses. You should be doing no more than 10 trades at any one time. Again, if you're new, bring that down to like 3 trades ongoing at any one time. You should write all your trades down, whether that's electronically on some sort of document or on a piece of paper in a notebook. 3-ring binders work well. Spiral bound binders work even better. And reevaluate this business plan every 3 months. See if it still fits. See if it needs a tweak or if it needs a full rewrite. All right. How to write a plan. I'm not going to read this to you. Pick up the PDF, take a look at it for yourself. Couple of points here, though. Right in the middle. The main point of a trading plan is to keep you calm and relaxed during your trade. I've planned for my entry. Here's where I think it can go to. Here are my exits if it goes there. Here is my plan for an adjustment if it doesn't go where I think it will. Very similar to what I send you in the advisory service. Next bullet point below it in red, your trading plan should be dynamic, which means don't set it in stone and forget it. Review it. If it needs to be modified, modify it. If it needs to be exited, exit it. The last piece, once it's completed, go back over that plan. What did you do right? What did you do wrong? And use it, those positives, for the next trade. Understand the negatives so that you don't make the mistake once again. All right, now that your plan is written, now what do? Well, you should be keeping, in my experience, a daily journal, a trading journal. What happened today? Why did the market do this? Where is the market expected to go? A great place to pick that up is in the document that I provided at the end of this presentation that you can kind of fill out. You can fill in the blanks. Another place to go is to ShadowTrader.net. Go to the Swing Trader Report under Stocks and read what Dan Sheehy says that he expects the market for a sentiment basis to do today, and use that as kind of your starting point for the day's action. Write down in this journal, what do I do on a daily basis? How often do I look at the computer? Am I involved in this thing, 24/7, or am I just looking at it once an hour, once a day, not even once a day? Write in your journal, how do I keep up with this on a daily active basis? So write down the time frames that you're going to take a look at the market. Put it in the journal so that it becomes a habit. Habits are repetitive. All right, here are the documents that will be included with the PDF. The journal, and then a trading plan sample. All right. Now let's go on to topic number 2, position sizing. As it says in bold, should be based on acceptable levels of your risk that you will assume. How much risk am I willing to take on? 2% of what I invest? 3, 4, 20%? You need to determine that yourself. Number 2, do all types of trades have the same risk of loss? Absolutely not. Absolutely not. You've got directional trades, and then you've got trades that work in multiple types of trends. Every trade has a different type of risk. Each one should be evaluated individually. Credit trades, your risk is a potential loss. You get paid to play. You receive the credit if and only if things don't go against you. Those are the bull puts, the bear calls. A debit trade. Brad, the PDF is going to come to you on the replay tonight at the end of the session. When I put this all together, put it in a replay, email it out to you, you'll be able to have the PDFs, okay? Good question, though. All right. Debit trades. Debit trades are where you pay up front to play. I'm investing $100 and I expect to get back 200. There you go. The placement of your strikes in your option trades may affect the probability of success. That's why I say an analyzer or a risk profile portion to your platform is key for me. It needs to be there. How about equity-based trades, buying stock? Equities do not have expiration dates. Yet, you should have a plan when you buy stock. I'm going to buy it at X, and I'm going to look for it to go to Y. Once it goes to Y, that's my expected return, I'm either going to sell it and take the money and run, or I'm going to put an option together with my equity to protect a degradation of my profit and have possible potential to the upside as it continues to go to the upside. So if you're doing equity trading, you can buy insurance to mitigate losses. You can sell insurance to enhance the return. As you get more adept in these options, buying and selling stock only becomes like, why would I do that? All right. How about portfolio sizing? How much of the portfolio should be invested in a single trade? That's up to you. But here's some guidelines. If you're willing to risk 1 to 2% of your total portfolio on a trade, simple math works out. I've got a $100,000 portfolio. This trade, let's say this is a bull put, which it is. It's a short put vertical, like we've done on Disney, like we've done on Lulu. I'm going to sell the 40 short put, which means I expect the stock to be above that $40 strike price between now and expiration. But that's a lot of risk, right? That's $4,000 on 100 shares, one contract. So I'm going to buy myself some protection to buy to open that 35 long put to cap off my loss. So I sell it for $285. I got to buy protection at $123. I get $1.62 in pocket. So my total risk on this $500 spread between the sale and the purchase, or the sale, the short put and the long put. So it's $500 minus what I collected in credit of $162, gives me $338 of total risk per contract. Remember, we did that with Lululemon. We did that with Disney. $500 of risk, but I picked up, $400 of risk, but I picked up $50 of credit, limiting my risk to less than the difference between the two strikes. All right. So if I've got $338 of risk based on a 2% allocation, how many contracts can I do on a $100,000 portfolio? It's simple math. So my $100,000 at 2% is $2,000 worth of risk. Divide that by the risk per contract of $338. I could do 6 contracts and still be within my 2% allocation for sizing. That's how you do the math for sizing. That's an example you can use. You can modify it. You can do it for a vertical short or a vertical long or even stock. Remember that $338 is your trade risk. The $2,000 is the percent of your portfolio you want to have at risk for the trade. All right. Now, what if the trade doesn't go as you expect? Bad things can and do happen. That's why we talk about secondary exits. You've got to define these before. I'll repeat, before you do the trade. On my trade plan, if it goes as expected, I'll take profits here. If it doesn't, if it goes against me, here are my additional plans to mitigate my losses. One could be, I'm going to kick it to the curb. Number 2, I could change it to another trend. Number 3, I could enhance the trade so that it makes money in the other trend. So secondary exits should already be in your plan before you push the go button. That means proper planning makes for less emotional mistakes. Sizing of this trade and sizing of the secondary exits comes into play. News should be evaluated on an ongoing basis to see how it is affecting your trade. But you got to think of, is this news just something that is sentimental? Like, oh my gosh, there was this happening overseas, but it didn't affect my stock. Or is the news something fundamental? I'm trading Apple, and all of a sudden Apple had a data breach. That could definitely fundamentally or materially affect the price of the Apple stock. Is it a technical situation? Did the stock go up to a level that it got too rich and now just pull back? So you've got three different aspects: technical, fundamental, and sentimental. The one that you'll be keying in on the most is on the technical at this point in time, and a watchful ear for the sentimental ones. Sentimental right now is trade wars. Fundamental is earnings. Technical is those footprints that you see on a chart. There's two others. Is it a macroeconomic, or is some sort of U.S. news affecting the whole market? And the other thing is it time to adjust or close just because I've been in it too long? What if you wanted to follow through on a secondary exit? Well, this is for ownership of stock. I'm not going to go through this. We don't do stock ownership here, but this lays out from that previous example if you wanted to follow through on a bull put and take ownership. Can you do it with your guidelines? I'll leave you to read this in the PDF. Here's the math. Here's some alternatives to it. All right. Lastly, on this plan, monitoring the trade. Each morning, before the market opens, take a look at your trade. Is it still looking like the same trade you put together? Is the price on the chart okay in your eyes? Number two, is there anything on the economic front that might change your outlook to the way your trade is going to perform? If so, such as the FOMC or the Fed having a meeting that day and changing rates? Are the numbers for the unemployment coming out that day that you might want to just kind of keep an ear to? Brad, BTO, buy to open, sell to open, those are in my original PDFs. So if you need those, let me know and I'll send you a separate sheet. All right, is there macro news? If so, does it affect the investment community's opinion on your stock or on your trade? Is there any equity specific news? Like I said, Apple. They had a fire in their plant in China or something like that. Is it a technical situation? Support, resistance. You should be comfortable doing some technical analysis. Now, the next part of monitoring, have you gotten to your primary exit? That goal that you want to get to. If you're there, the best thing you can do to build up a positive mindset is to take your profits. If you're in the credit trades, are we still going towards that primary exit of zero? Are things still looking good as far as price? The last part with the Greeks, until you get more adept at this, I'm just going to leave this in the PDF and you can think about it. All right, once the trade gets towards adjusting to the point where you think it needs to be adjusted, go back to your original plan. Where did I think I could adjust my trade and what did I think I could adjust it into? Redo the plan. Is the trend the same? Develop a new expectation for where you think the stock is going, up, down, or sideways. What other trades should I think about? A bull put, a bear call, a directional trade. Define once again an exit for that adjustment as primary and possible secondary exits. And then place the adjustment and go back to monitoring the trade. All right. So let me go back to a couple of things about this plan. Define your goals. Size your trade properly with good portfolio management. Maintain enough cash in your portfolio to follow through on what you said you would do. If you're still paper trading and you go to real live trading, do it slowly. Do it when you've got this planning stage down to where you're comfortable with it. Try to keep your emotions out of your trading. They're going to be the worst part of your trading plan when you get all excited. By examining your old trades, finding the things that worked and using them for a new trade, and then things that didn't work and kind of understanding and try to not do those bad things for a new trade is going to be absolutely the best way to then be profitable in your trading. All right. The bottom, adjust when you have reason to do so, and be clear as to why you adjusted. And I always like to say, take your profits at your primary exit. Make this a positive follow through on your trading. All right. Now, quickly, I'm going to go through some flow charts, not each individually. Print these out, put them in a notebook, and use them as a guideline when you're planning a trade. We'll talk about long calls, long puts, the call vertical, which is a bull call, the put vertical, which is called a bear put, a short call vertical, sometimes referred to as a bear call, and a short put vertical called a bull put. The last one, this bull put, is what we've done with Lululemon and Disney. So here you go. On the long call, at the top, you'll see the long call, 45 days of value. So you monitor the trade. Left and right of that, you've got bullish or bearish. Is the trend going bullish or bearish? Or stagnant, follow through. And you can follow this flow chart for possible adjustments to a long call. Same thing for a long put. On the bull call, this is a call vertical. Direction is lower left to upper right. So at the top, the long call with a lower strike than the short call, having the same expiration. Right below that, put the trade on, you monitor the trend. Left and right of that, is the trend going bullish? You're going towards your primary exit. Keep going. Is it bearish? Uh-oh, things have changed. Now here's an exit point that you can look at for adjustment. If it's stagnant, here's a secondary exit that you can use. Again, long call, long put, the bull call, and this one, the bear call, or the bear put, pardon me, are all directional trades. They work in only one trend. They do not work in a stagnant trend, and they do not work in a slightly negative trend to the one that you're in. I've put these next two flowcharts in green because they are credit trades, whereas the ones in black are debit trades. Debit trades, you pay to play. You know what your maximum loss is when you enter it. On a credit trade, you're paid up front. That's your profit. Your risk is a multiple of that profit. Therefore, you are being paid to play, assuming more risk than your reward. But here's a short call vertical, also called a bear call. Here, our short call is at a lower strike price than our long call. We're expecting the stock price to go up to, but not go over, our short call strike. This type of trade works in three trends. It works in a bearish trend, absolutely perfectly. That's where your primary exit comes in and you allow it to expire. It works in a stagnant trend because we make money as extrinsic value erodes and the short strike is not eclipsed. In a bullish trend, it might work if it's very slightly bullish, but more than likely, you're going to want to escape this trade quickly if that trend goes from bearish or stagnant to bullish. And I've given you a couple of secondary exits. That's on the bear call side. Now, like our Lulu, like our Disney trades, these are put verticals, short put verticals, also called bull puts. Bull for expected trend is bullish. Puts, we're using the puts as our option vehicle. Here, our short put, the one that we sold, has a higher strike than the one that we buy for protection. Just like our Lulu and Disney trades ongoing. This trade, this put, short put vertical, works in a bullish trend or a stagnant trend. It may work in a bearish trend, slightly bearish, but I've given you alternatives or exit points, secondary exit points if it starts to go bearish. And folks, that concludes our lesson for today as far as the instructor-led part. Take this from the replay or from the weekend email that you're going to get. Take a look at it in the PDF or in the replay. Print out those flow charts. Print out the trading plan samples. And if you've got any questions, you know where you can reach me. So please send me an email if you have questions. All right, folks. Any additional questions? All right. I'm still here. You're welcome, Eric. Brad, I'll tell you what. Since you don't know the abbreviations, I will include in this weekend's email to everybody all of the lessons that we've done up to this point. Lesson 1 of what's an option to lesson 8, how do I do a trading plan, and all of the adjustment flowcharts. You're very welcome, Brad. Okay, everybody. Thank you very much. Have a great rest of your day. I'll get this replay out to you probably within the next hour, hour and a half. Bye-bye for now.